Hello, welcome back. By way of introduction, my name is Jack Elder, Senior Director for Advanced Planning with Comprehensive Brokerage Services. Uh, we're going to continue our conversation about intentionally defective grantor trusts and their strategic uses with life insurance. Last week, we discussed foundational information about grantor trusts. This week, we're going to get into some practical application with strategic gifts, specifically gifts before 2026, before the exemption cuts in half. So again, for clients where these designs make sense, whether it's strategic gifts, installment sales, private split dollar, premium financing, you're talking about a high net worth family that has income producing appreciating assets that are concerned a bit about efficient wealth transfer, and because insurance is crucial to the design, they're insurable. So quick recap on grantor trusts in general. They have 4 benefits: what I call gift tax-free transfer, my payment of income taxes on behalf of the trust doesn't count as a gift. The money I spend on those taxes won't be subject to estate taxes someday, right? These are funds I'm already going to use for income taxes, whether or not the assets in my estate, and I'm burning down my estate on behalf of the trust. It gives the opportunity for tax-free transactions, which we're going to talk about in our next 2 presentations. That's installment sales and split dollar. And it removes future appreciation of the transferred assets from the reach of the U.S. transfer tax system. So that's the general background. It's crucial that life insurance, is in the mix for a variety of reasons. The trust can often pay part or all of the premium to avoid future gifts, to preserve the client's exemption for other assets. The proceeds, income and estate tax-free, if designed correctly, are immediately available in trust to cover estate taxes. The internal rate of return, highly competitive. You're looking at on the death benefits, somewhere between 6.5%, and 9%, depending on how the policy is designed. And these assets are not going to be, this asset's not going to be correlated to the rest of the client's portfolio. So it's the ideal financial tool for efficient wealth transfer. And I'm going to show you some math today to underscore this point. So before we get into our example, let's just take a look at the state of the estate tax. The U.S. transfers taxes wealth transfer. Estate taxes are due at the client's passing, or for a married couple at the passing of the second of them, generally speaking. It's backstopped by the gift and GST tax. And not only do the feds tax wealth transfer, but 17 states plus DC also impose a separate transfer tax. So what gets taxed? The way the tax works is pretty simple. In theory, you add up the value of all your assets, your real estate, your business and farming interests, stocks and bonds, other miscellaneous property, etc., powers that you have over someone else's wealth, to appoint it in your direction. You add up the value of all that stuff. That goes on one side of the ledger. On the other side of the ledger, you get some deductions, and they're paltry, frankly, compared to, say, your income tax return, which could have heavy deductions. In this case, it's your funeral expenses, debts, administrative costs, and then key transfer to spouses, which is why estate taxes are generally owed at the second death, and charitable contributions, which can be super powerful. Whatever's left after you add up the value minus your deductions is protected by an estate tax exemption. And the estate tax exemption is pretty darn high right now. In blue, you see the estate exemption for singles, and orange for married couples. It's indexed to CPI, so you can see it grows a little each year. But look what happens in 2026. The exemption drops. The Trump tax cuts expire, and the exemption drops. The next few years represent the time for action, because once you exceed the estate tax exemption, once you have more than $1 million in excess, well, the whole thing's taxed at 40%. So it's a highly compressed rate structure, right? Where income taxes, the brackets are somewhat spread out. In the estate tax, it's highly compressed. Once you go over $1 million, everything's subject to 40%. So it's essential that clients, high net worth clients, take advantage of this opportunity they have before the end of 2025. And then once your estate tax bill is determined, you have 15 months to pay it. So 9 months plus a 6-month extension. So this is an urgent matter for families with high net worth that they need to plan and execute on their plan before the end of 2025. And I'm going to go through an example of what no planning looks like, gift planning, and then gift planning plus life insurance. So let's look at that example. We'll start with our clients. It's a married couple. They're both 65. They're concerned about their legacy and their Colorado residence. This is a real case, as you'll see, because I'm going to show you the deliverable we provided the advisor at the end. Their personal residence, 1.2 million, not big spenders. They have assets under management of 4 million, and he founded and has had a very successful decorative concrete manufacturing company. That's worth 20 million. He said it's appreciating at 10% and taking off $500,000 in income every year. They're going to have a staggering estate tax bill if you think about where their wealth is headed and what's happening with the exemption. So working with the advisor, we came up with the following assumptions. Both clients are 65. Their estimated longevity is 23 years. They're married. Their current estate is just a little bit more than 25 million. They haven't used any of their exemption yet. And they've decided he's willing to make a gift of $5 million to trust. And he's already done that, frankly, but that's what he was comfortable doing. And then we also assumed that all of his assets would compound at 4.5%. So we, for these purposes, kind of set aside that staggering 10% compounding that business is doing and just said 4.5 because we want to use realistic conservative numbers. So let's look at that current scenario and compare it to strategic gifting before 2025 with and without life insurance. So here's his current situation. Over their joint life expectancy, they're at 4.5%. Their wealth will grow to about $66 million. The estate tax on that will be 18 million. 47 million goes to heirs, which unfortunately means Uncle Sam got 28% of their wealth. Is there a better solution? Well, here is strategic gifting without life insurance. So their projected estate is 53 million, a little smaller because they've taken 5 million and put it in trust for it to grow outside the reach of the transfer tax system. Because their estate is smaller, their estate taxes are less. That also means the estate assets that go to the heirs is slightly less. Look what they've done. They've taken that 5 million, which grew, assuming that 4.5% rate, to 13.1 million. So their combined net to heirs is 49 million, which is, they still lose 24% to taxes because he only wants to go so far with this gift. He's still controlling the company, doesn't want to give up too much ownership stake. He's got other plans for that exemption. So the tax is still staggering, but look at that. Just by retitling, repositioning some assets, strategically using their exemption, they've improved the net to heirs by $2.4 million. So under the original plan, 47 and change. Under the new plan, 49 and change. That's a 5% increase. So that 5% is a lot if you add it up over a lifetime. So pretty good plan. We can do better. So here's strategic gifting with life insurance. So their projected estate taxes, and estate assets to heirs remain the same. Where the big change is inside the trust. So that trust that he has funded, note that in this case, the trust assets grow to 5.6. In the previous example, they grew to 13.1 million. Why is that? Because we're using a portion of the trust assets to purchase life insurance. In this case, we bought a $15 million policy, which brings his combined net to heirs up to 57 million. That represents original plan, or currently we're at 57. The original plan was 49, right? So that's a pretty significant difference. The family is $9.9 million better off which is they're 17% better off. All we've done is take advantage of the exemption before it drops, made a gift to trust, and then allocated a portion of that gift to life insurance, not the entire amount. And by the way, this is dialable. If you have a client that wants to make a bigger gift and purchase more insurance, that's great. If you have a client that wants to make a big gift and purchase a smaller amount of insurance, we will meet you and your clients where they want to be met. This is what this client preferred. So how can we help you start this conversation with your clients? The purpose of the deliverable I'm about to go through isn't a substitute for tax or legal advice. Instead, it's a conversation driver. So with just a few bits of information, your client's age, marital status, current net worth, some basic growth assumptions, and whether or not they've used any of their annual gifts, we can provide you with a great tool to drive conversation. So here's the first page. We call it strategic gifting before 2026. It's co-brandable, as you could see. There's a little logo up there. That could be your logo. We go through and explain the current and future state of the estate tax, which you saw in previous slides. There's a call to action. After 2026, if you haven't used your exemption, you lose it. That's what this emphasizes. Here are the client assumptions. On the second page, we go through the three scenarios. First, what's their current scenario? This is the do nothing plan. Second, making a gift without using life insurance. In this case, family's 5% better off making a $5 million gift. And then coupling that gift with life insurance is the final option, which shows you that almost $10 million improvement, 17% better off, and it closes with a nice little visual to illustrate the benefits of each design. We are happy to present this on your behalf, prepare it for you, whatever you need to bring that actionable conversation to your clients. I promise you, they will appreciate the conversation, and that it will lead them towards starting the wealth transfer process now if they haven't done it. In not all cases are the clients going to do exactly what this strategic gifting deliverable recommends, but you're going to start moving in that direction, and that's the key. It leads to real planning, and often results in life insurance sales when that's warranted. So that's strategic gifts with grantor trusts. Over the next few weeks, I'm going to be talking about installment sales, private split dollar, or private intra-family loans, however you want to think of it, and premium financing, and how intentionally defective grantor trusts work with each of these designs to enhance them. We can model all of these designs with simple deliverables like the one you saw, or more complex. We provide point of sale support for you, and to work with your clients directly if that's what you'd like. And then also to work with the client's other professional advisors, their attorney, CPA, CFO, trust officers, whatever you need. In the meantime, here's my contact information. Please don't hesitate to reach out. We look forward to working with you. And with that, have a great day.